Consumer debt delinquency rates, along with the speed of transition into seriously bad debt, continue to rise, driven by a massive surge in soured student loans. And the reason for that surge is the same one behind the main U.S. Services Index falling into recession territory, driven largely by weakness in employment, further confirming the shocking jobs data that we got last week. Now, rising delinquencies aren't necessarily a problem for banks, at least not at this stage. What they do provide, though, is more confirmation that incomes, they're just not there, nor are the jobs. If the economy keeps going the way it has been, if the labor situation keeps getting worse, then the banking and financial sectors, especially shadow banks, are going to run into some big trouble. But at this point, we're looking for evidence that the forgot how to grow economy really remembering how to do worse. Delinquencies fit that, as does another, quote, unexpected drop in the ISM Services Index. Both it and its manufacturing PMI cousin were below every expectation for July, each one solidly in the alarming category. And each one had its employment index right at cycle lows, further corroborating the payroll report from last week, if not raising the chances for more negatives from it. Yes, I mean more negatives. So rising debt delinquencies, the ISM's unexpected weakness in both sector PMIs, employment indexes at clearly low levels, and these updates following the July jobs numbers and revisions to previous months, all of it fits very neatly into the overall economic trajectory that's priced by the swap market all this time. Rates going down by a lot to stay there for a long time. You got rising debt delinquencies, both ISMs in clearly weak territory, not to mention the employment indexes that are corroborating last Friday's jobs shocker that wasn't really a job shocker, and all of it adds up to exactly what the swap market has been pricing the entire time. A pathway for the US and the global economy toward lower interest rates, or interest rates that go a lot lower and then stay there for a lot longer. Now, we aren't there yet, but all this evidence that we're getting from all over the place, from all these different sides, is consistent with an economy that is transitioning into that future state. And as all the evidence comes in, it continues to come in on that side. And almost nothing comes in to refute it. So no wonder the bull steepening is reaching the yield curve, hanging around this week after the plunge in rates last week. It's confirmation for the unusual levels of weakness that are coming in from everywhere. No matter how much or how many times the inflation-obsessed Fed protests that everything is just fine, and as Powell always says, solid. But according to the Federal Reserve Bank of New York, loan delinquencies, they're on the rise. According to the latest figures from the FRBNY, the percent of consumer loan balances that are 90-plus days delinquent jumped to 3.04% in the second quarter of 2025. That was up from 2.84% in the first quarter, and the rate had been just 1.83% in the second quarter of last year. So that's a full percentage point pickup in just a year, the same when labor market difficulties became far more serious and outside the Fed and the mainstream media, far more obvious. It's also the highest rate since the first quarter of 2020, but still only just getting back to pre-pandemic levels. That's because mortgage delinquencies have been historically low, and mortgages account for, by far, the most outstanding consumer debt. So it's a different story when you've set aside mortgages. We're talking about auto loans, credit cards, and now student loans, as I'll get to in just a moment. But outside of mortgages, the percent of serious delinquencies in credit cards, an important one, was 12.27% in the second quarter, basically unchanged from the 12.31% in the first quarter. And these are the highest numbers for these rates since the first quarter of 2011, illustrating the degree of distress in the consumer economy right now. And for auto loans, the percent 90-plus days behind was 4.99% in both the first and second quarters, up from 4.17% at the end of 2023. And outside of 2020, those rates in the first and second quarter this year are the highest since the third quarter of 2011. So already we're off to a questionable start here with consumer credit cards as well as auto loans showing higher and higher transitions into serious delinquency, which again, as I said in the introduction, not yet a concern for the banking sector, more confirmation of an economy that's heading toward the direction, which if it continues in this direction will lead to stresses, which will then become a problem for the banking sector, especially the shadow banking sector, which is one reason why we saw the violent reactions to macro risks back in April, and why U.S. banks, U.S. dealer banks, through repo had to bail out those shadow banks because of the clear path heading in that direction. All of it consistent with the swap market pricing rates going down by a lot and staying there for a long time. But delinquency rates more recently, those are being driven by missed student loans. And as the FRBNY report itself said, missed federal student loan payments that were not previously reported to credit bureaus between the second quarter of 2020 and the fourth quarter of 2024 are now appearing in credit reports. Consequently, student loan delinquency rates continued to rise. In the second quarter of 2025, 10.2% of aggregate student debt was reported as 90 plus days delinquent. Here's the thing though. This is being led by older, quote unquote, students, where the transition rates are highest for those with student loans who are over the age of 50. Don't ask me here, with a higher than 18% transition rate into serious delinquency. The second fastest transition rate is among those who are aged 40 to 49. So no jobs, no incomes after taking out loans to maybe get a re-education or a first education, presumably. They were led to believe the economy was in a labor shortage and would be churning out new jobs forever forward. And so they went into education, took out a bunch of loans that they could no longer pay for. It's another painful, even destructive consequence of everyone believing the pandemic economy was recovering when it never was and it never did. And by the way, if you want to go deeper into these topics, but you maybe don't want to go as deep as our deep dive analysis, we have the subscription service for you. It's Eurodollar University's Substack subscription called the One Big Weekly Thing. We take the biggest thing that happens during the week, and we know what we know what it was last week, and we pull it apart, we analyze it from all the Eurodollar University perspective, and we give you all the relevant details from across Eurodollar University that gives you insight into what's happening, what it is, and why it really matters. So check that out. There's a link in the description. The One Big Weekly Thing, Eurodollar University Substack subscription. As Bloomberg put it this morning on the latest data on delinquencies, the rise in delinquencies suggests American households are facing increasing financial distress this year amid high interest rates. That's not really a factor. And here's the thing, a slowdown in hiring that might be worse than a slowdown in hiring. Recent data show consumer spending fell in the first 6 months of 2025, even before tariffs started to boost prices. And that's something I pointed out too. There is a process here, and this is the process that we're trying to analyze and get evidence for. Consumer sentiment crashed. The Fed said it was an overreaction to tariffs. However, consumer sentiment crashed, and consumer told us why it crashed. It wasn't necessarily tariffs. They were afraid for jobs and incomes. Not only did sentiment fall off, spending did too. As the Bloomberg report and the Bloomberg article just pointed out, spending in the first half of the year was actually negative for one of the few times we've ever seen that happen outside of recession. Or maybe outside of recession. So consumer confidence crashed, spending fell off, and then now we're getting all this evidence from all over the place that yes, jobs and incomes aren't just threatened, they're actively being cut back. We got that from the payroll report, and we're getting it from a whole bunch of other stuff, and it's consistent with consumers becoming increasingly delinquent in all these forms of consumer credit, up to and including student loans, where student loan delinquency is being driven by older Americans. It's all about the same thing, which is Jay Powell is wrong about how solid the labor market is and how solid the economy is. It isn't solid. It has been forgetting how to grow. And this year, it had forgotten a lot more. If you remember, just last Wednesday, Fed Chair Powell told reporters at his press conference that, first of all, delinquencies are, quote, not a problem, and that essentially you have a consumer that's in good shape and is spending, though not at a rapid rate, when none of those things are true except for the fact that maybe delinquencies aren't yet a problem for the banking sector. And before that, he said in his prepared remarks, in the labor market, conditions have remained solid. So everybody believes this. This is what the jobs market looks like. And then he added payroll job gains average 150,000 per month over the past 3 months. And I hope he regrets making that statement because the BLS completely turned that around in their numbers that were released on Friday. 150,000 average? No, closer to zero. And as we'll see, very likely negative during that 3-month period. But as far as delinquency goes, that's the point at this stage. It isn't about a possible bank crisis where depositories get overloaded with bad debts. Those bad debts can be a problem down the road if this economy keeps going in that direction. What delinquencies instead really point to in the near term is this weakness in jobs and incomes. They're another warning sign that income growth and opportunity has fallen off significantly enough that workers can't afford to pay for necessities and pay back borrowed money at the same time. And with more and more struggling to do even that, there's going to be less discretionary spending, which is exactly what we see all throughout the services economy, including the latest data from the ISM that was unexpectedly right about 50. Analysts were expecting the index to pick up to 51.5, especially given the flash reading in the S&P Global Services Index, which was revised even higher from that initial reading. But SPG has consistently been the positive outlier in the services sentiment data, whereas ISM got boatloads of corroboration all over the economy. Remember, as I've been pointing out the last couple of years, anything under 53 for services sentiment is consistent with the economic danger zone. So this month for July, right about 50 and even below it as we've been in a couple months along the way, that's consistent with full-blown, traditional, the NBR will recognize this eventually, our word. So the ISM index overall follows the same artificial pattern as we see everywhere else, rising to a high of 55.8 last October after the turbulent summer, to say the least, where the index had fallen below 50 last June to kick everything off. But since that high in October, the services PMI has been decelerating, not in a straight line, but back and forth, yet moving downward, being strangled more and more by consumer confidence, crashing on fears over jobs and incomes that are proving more and more to be real, not just emotional overreaction to tariffs. So the 6-month average for the ISM Services Index dropped to just 51.12 for July 2025, which matches exactly the cycle low set last August, right before the artificial high kicked up. Only this year, there is no artificial factors lurking in the background in the fall to save the economy, and the economy is in far worse shape this summer compared to where it was last summer. We see that in the debt delinquency data, we see that in the employment numbers. It's basically everywhere. So the ISM index is revisiting where it had been last summer when the Federal Reserve was provoked into belatedly reacting to the weakness by cutting by 50 basis points in September after refusing to get ahead of all this and cutting by 25 in July. Sounds familiar. The big one for the ISM, though, it's July employment index. It dropped to just 46.4 from not a great one, 47.2 in June. That puts it among the lowest months for the entire post-pandemic cycle. And now its 6-month average, the employment average, has slid back to just 48.9 as employment prospects are clearly worsening as the year drags on. But the other side of that is the reason why employment prospects have been so grim, and that's input prices are continuing to climb. The prices paid index for the ISM services rose to 69.9 here in July, its highest since November 2022, indicating just how precarious it is for service providers. They try to raise their prices for customers, and their customers disappear. And if they don't raise prices, they have to cut costs elsewhere, starting with labor, either trimming hours even more, or, as the latest employment data confirms, outright reducing headcounts. And this shocker for ISM services, well below expectations, was followed by the same thing happening in ISM's manufacturing index, which was kind of lost amidst all the fury from last Friday's jobs report. What the ISM reported Friday was that the manufacturing index unexpectedly declined to 48 from 49 in June. The new orders index was slightly better, though effectively unchanged at 47.1 versus 46.4. But just like in the services index, you can clearly see the artificial ups and downs from the tariff distortion over here on manufacturing. You got to a high of only 50.9, by the way, back in January. But back in January, when it rose above 50, everyone went crazy over how the ISM manufacturing index had gotten above 50 and how that must have represented the start of a producer renaissance, that the goods economy was finally coming back after a multi-year forgot how to grow recession. Instead, It was indeed another artificial illusion, with the ISM manufacturing index, like the economy, sinking toward payback and renewed, even accelerating weakness that we see everywhere else, including ISM services. But once again, it was employment conditions which really stood out, especially given the context of the dismal jobs data. For ISM manufacturing, the employment index crashed to just 43.4, down from an already bad 45.0 back in June. That equaled last July for the worst employment number in the index and in the manufacturing sector since June of 2020. So it's not just sentiment in PMIs, or it's not just sentiment among consumers. We're getting all of this indication, all these indications that are consistent with an economy that is falling off, and maybe falling off pretty sharply. It's getting toward and moving toward that long run future where interest rates go down, they go down by a lot, and they stay there a long time. And here's insurance and annuity provider ING's take on the ISMs. More disappointing U.S. data today in the form of the July ISM Services Index, which fell to 50.1 from 50.8, rather than rise to 51.5 as predicted by the consensus. As with the manufacturing ISM survey from last Friday, this was weaker than anyone surveyed had predicted. Employment fell to 46.4 from 47.2, which doesn't bode well for August jobs report, given we already knew the manufacturing employment version dropped to the weakest level since June of 2020. If we weight them 90% for services and 10% for manufacturing, we see that these readings are historically consistent with non-farm payrolls dropping by more than 100,000. While the relationship with payrolls hasn't been as strong since the pandemic, that's because of the overestimation of the payroll report, at the very least it suggests we should be braced for soft jobs growth through the second half of the year at the very least. I say at the very least twice, but it doesn't really matter. The point is being made more than twice. Employment weakness is all over the place. And because the payroll report overstates job weakness, the reality, or closer to the reality, comes in the form of its revisions. And as I said in the introduction, the main payroll report, the establishment survey, is very likely already negative for 3 months running, which would be, of course, consistent with what ING just said about the ISM indexes. That's the thing about Friday's BLS report. It wasn't just a single week month, as Cleveland Fed President Beth Hammack stated when she appeared on Bloomberg after the data came out. But given the revisions, it was functionally 3 negatives in a row. First of all, both May and June were revised to nearly zero, just 19 and 14,000. Those are already indistinguishable on a statistical basis, as well as in reality, from a negative month, a month when jobs were outright dropping. So you got that both in May and June. And then July comes along with just 73,000 in purported gains. But as I pointed out, the average downward revision for the entire first half of 2025 is a whopping 77,000, meaning that July has a wickedly high probability of also being less than zero once it is revised over the couple months ahead. And all that would indicate, like the household survey already does, that jobs in the U.S. economy are being lost for 3 months running. And with the ISM looking forward, as ING puts it, it's very likely it's going to continue through the summer. So how is the Fed going to respond to that? Well, that puts a 50 basis point rate cut on the table in September at the very least, which means, again, we're on the road to where swaps said, rates going down by a lot and staying there for a long period of time. We're still early in that road, and that's the scary thought. And it's also consistent with not just the data that we're talking about here, but also the more recent drop in the front end of the yield curve, the bull steepening that's taking place there, the sharply steepened inversion in the forward rate curve, SOFR futures, not to mention all the rest of the data from consumer spending being negative in real terms for the entire first half of 2025. So rising delinquencies being pushed by student loans falls right in line with all of it. Higher delinquency rates and transitions offer even more confirmation. Confirmation for what? That the forgot how to grow economy is remembering how to do worse, consistent with the path laid out by the swap market, which eventually leads to conditions where interest rates go down by a lot, and stay there for a long time. The past few weeks, we've gotten tons of confirmations, almost uniform confirmation, apart from the FOMC's press conference, especially the press conference performance by Jay Powell, who in light of all of this data and in light of all these updates, probably wishes he didn't come out of his office last Wednesday. So what we just went over is the macroeconomic backdrop to what's happening in the front end of the interest rate curve. And I went over all those details in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's subscription service at Substack. Huge thanks to Eurodollar University members and subscribers. And until next time, take care.